Good morning, Daniel.
Good morning, Dan.
What are we chatting about today?
Instead of three topics today, I thought we would do one big, beautiful topic.
Welcome to the Science of Wealth, where we discuss the science behind financial planning and the art of learning and applying it. Hey everyone, quick interruption before we get into it. I don't love this episode, not because of the topic, but because the audio is even worse during portions of this recording than it is with my audio right now, recording this in my home office. We had some unknown issues during the recording that we weren't aware of at the time, and unfortunately, we don't have the time to do a full re-record of an almost hour-long episode. So I want to apologize up front if you have a hard time understanding certain portions of the podcast, and if you have questions or couldn't follow certain parts, please feel free to send me an email, and I'll be happy to clarify for you or answer in a future episode. Thanks, and try to enjoy. Oh boy, we're going to talk about taxes the whole time, aren't we?
We sure are.
All right, hit me. I assume we want to talk about the big beautiful bill. So where do we want to start?
I guess from the top, it's if there's one thing this bill is, it's big, and there's a lot of items that are going to impact taxpayers, and a lot of it's extensions from the Tax Cuts and Jobs Act, and people need to plan around it and be educated on it. So, what would you say is the first place to start here?
I mean, I think the most obvious place is just like literally what are my taxes going to be? And you already said it perfectly. It really is an extension of the Tax Cuts and Jobs Act. Really, they should have just called this TCJA 2.0 or something, because it really is just a continuation. So, for example, Tax Cuts and Jobs Act back in 2017 cut a lot of our tax rates in little ticky-tack ways. 15% became 12%, 25% became 24%, a lot of stuff like that. And that's just going to be continued now, essentially, in perpetuity. Note when I say something like, permanently or in perpetuity throughout this whole conversation, really what we're just saying is until the government decides to change their mind. So with that in mind, our tax cuts are kind of our tax rates are going to be 10, 12, 22, 20, 24, 32, 35, 37 for the foreseeable future.
Okay, so for somebody who doesn't follow tax every day, this essentially just means no changes.
I mean, essentially no changes. Now, there's some little tweaks here. So, like this year, the standard deduction was supposed to be 30,000 for married filing jointly, 15,000 for single people. They just slapped an extra $750 on that per person. So now single is going to be 15,750, and married filing jointly is going to be 30,000 or 31,500. So for better or worse, like there's little extras that are sort of being slapped on there. But generally speaking, essentially our tax, if we just had to boil it down to like, are our taxes changing? Kind of just no. And there's a lot of the changes are picky tax specific items as opposed to big changes like it was back in 2017.
All right, well, that overall sounds like good news then for some filers. And for the standard deduction, like, is that a set amount? Does this increase every single year? How does that work?
Well, it's all increased generally with inflation. But like one of the big changes of the Tax Cuts and Jobs Act was that they changed a lower standard deduction for single people, married people, et cetera, into a larger one in return for cutting out a lot of the itemized deductions that people were using to do itemized deductions anyway, and essentially made it that for a lot of taxpayers, the standard deduction was going to be the default going forward. Like you're just almost never going to have an itemized deduction. So something like, 1 in 5 people used to itemize, and after the TCJA dropped down to like less than 1 in 10. But now, with some of the expansion here, we're starting to move back in the direction where itemizing might make more sense for some folks. But yes, to your core question, those typically have increased by, a couple hundred, a little over $1,000 a year. And they sort of levelized it where just, whatever the number is for single was going to be the number for married, just times two.
No, I think that's an interesting point that there used to be greater importance on itemizing, or more people itemized, and now more people take that standard deduction. I don't think a lot of people understand that just because something is deductible doesn't mean they actually reap the benefit of that deduction. A lot of people do something that they think is deductible, and maybe if they itemize, but they actually still have a standard deduction that is greater than the sum of their itemized deductions. And it seems like that's still going to be the case, but maybe some people will now itemize that didn't in the past.
Yeah, and it's interesting, right? Because I'll use a really common example. Like most people give to charity at some point throughout the year. Whether that's like $20 to this cause every paycheck, or you do $100 for your friend's 5K for a cancer foundation or something like that. And you can technically claim that on your taxes. You've always been able to claim that on your taxes, but often you never actually got the benefit of that donation. We can talk about it a little bit later, but there's some language in this bill that actually means that you're going to get some deductions for that, whether you itemize or not. But previously and historically, you used to have to itemize to really get the benefits of things like charitable deductions.
All right, so tax rates stay the same, slightly larger standard deduction. What else we got?
So there's a really weird one here, and I think it's kind of complicated because when the tax cut or when the big beautiful bill passed last week, which I guess is the time of recording, it'll be as of 2 weeks ago. But with that in mind, when it passed, there was an email that went out from the Social Security Administration, obviously political, obviously partisan, but essentially it just said like, we're so excited, Social Security is essentially going to be tax free now. We've done such a good job. Yay yay. And that is not true. What they did is they added a $6,000 deduction for folks who are 65 and older, and there was already a bonus deduction on the standard deduction for people who are seniors. But effectively, this extra deduction is really targeted at people who are either substantially or entirely living on Social Security past the age of 65. Because what it is that this deduction exists up to only $75,000 in income if you're single, or 150,000 as a household, and then it phases out past that point. So it's really targeted here in saying, like, we've added this extra standard deduction. So if you're single, it was 15,750. Now it's 21,750. If you were married, it was 31,500. Now it's 37,500, right? And we're adding this on. And with those deductions in mind, if your income is below 75,000 or your income is below 150,000, Social Security is not taxed on certain dollars. And then past a threshold, 50 cents on the dollar is subject to a tax. And then past another threshold, 85 cents on the dollar is taxed. So essentially, they have in practice eliminated Social Security income taxes for people who are on the low end of the Social Security income spectrum. But it's not quite genuine to say that we actually just like remove taxes on Social Security. If you're a higher earner, if you have a lot of savings, big pre-tax IRAs, para pensions, those sorts of things, you're definitely still going to be paying some taxes on your Social Security income in retirement.
You mentioned that the tax rates and the standard deduction increases, like they're here for the foreseeable future until further notice or legislation decides to change them. Is that the same for everything we're discussing in this bill?
That's a really excellent question. So that's a change that's not permanent. It expires in 2028. So essentially, from now through the end of the current presidential administration, this extra deduction will be there, and that will create an impetus on Congress in 2028, and more likely, honestly, in 2029, to have a conversation about whether they want to renew it or extend it or make it more long lasting or permanent. And bear in mind, I'm going to mention some other things during this conversation where essentially a lot of this stuff only exists during this current presidential administration and expires at the end of 2028. That is absolutely deliberate. And if I wanted to silver linings it, the deliberate part here is that when you reduce taxes, somehow in some part of the tax code, you have to have a mechanism for how that will get offset later. So putting time limits and expirations on taxes allows you to play this political game where, well, this will expire in the future and therefore will make up the revenue or the costs later on. And then the trick then is you can just keep saying that every time it comes up for renewal. So for example, things that are in this bill, have come to pass that were essentially we were told we're going to expire at the end of 2025, like the tax brackets, right? The 10, 12, 22, 24, 32, 35, 37 that we have from the Tax Cuts and Jobs Act that are extended by the Big Beautiful Bill were all set to expire at the end of this year. And it was part of how that bill passed in the first place back in 2017 was, well, we're going to do temporary tax cuts. And then later on, taxes will revert. And then that helps with how they score the fiscal impact of these things. So it's sort of kind of speaking out of both sides of your mouth. Simultaneously, this is a tax cut that will expire. Therefore, it will not have as much of a financial impact as if it never expired. And then also we're going to keep saying that every time we reserve the right to renew it, every 2 years, 4 years, whatever.
What a tangled web we weave.
We get the government we vote for, Daniel, whether we like it or not.
It's a good thing there's some folks out there that have financial planners who keep tabs on all these dates for them.
I think honestly we should actually be more grateful for the tax preparers who have to remember that this stuff is going to stay in effect or expire as they're advising their clients about whether they should do stuff this year or next year, right? Like as financial planners, we get to zoom out a lot. So like a lot of this stuff is interesting for the next couple of years, but like it's kind of a footnote in how I think about taxes long term. Whereas if you're a tax preparer, like you got to know the code this year, every year, and you got to think about it this year and every year in a really specific way. So I have a lot more sympathy for your highly qualified tax preparers than I do gratitude for us, the financial planners.
I'd say this is one of those times I don't necessarily envy their position.
I'm surprised you don't want to be one, Daniel Stefanski, enrolled agent of the IRS.
I enjoy the concept, I think, more than the realistic application and preparing the taxes, I'd say.
That is very fair. That is very fair. Let's should we talk about maybe some itemized tax things since the standard deduction just sort of bumped up and we're trying to apparently eliminate itemized stuff, but for where we're not eliminating itemized stuff.
Okay, great. In itemized deductions, is this primarily focused on business owners or W-2 filers here too?
So for itemized deductions, not really focused on anybody in particular. Now, I think business owners are often going to be more common beneficiaries of this, or ultra high income W 2 folks are going to be more common beneficiaries of this. But I don't think that really anything in the itemized adjustments this particular time around are really targeted at employees or business owners. So, like, I'll give you an example. Mortgage interest used to be deductible up to $1 million of home value prior to the Tax Cuts and Jobs Act of 2017. And then they dropped it down to $750,000 of home value. And decided to continue that. That was going to expire at the end of this year, but they've decided to say, nope, for scoring purposes, we're going to keep it. If you borrow less than 750,000, you can deduct all the interest in your mortgage if you file itemized. But if you borrow, $1 million, $2 million for your big house, or maybe your tiny condo in San Francisco or Manhattan, unfortunately, you will only get to deduct up to a certain threshold. So that is just something that very heavily favors lower cost living states. Again, not to really make too many political statements here, but red states tend to be cheaper than blue states. Real estate tends to be more expensive on the coasts than in the heartland, et cetera. It's kind of a pretty obvious thing where it's like, well, let's go ahead and put a cap on it because it kind of screws over the people in states that are not my state, if you're a senator from Iowa or something like that.
All right. I feel like that's a pretty big itemized deduction, though.
It can be. The weird thing here is, right, we didn't base it on how much interest you pay. It's based on how much you borrow. So, for example, if you borrowed $750,000 at 3% back in 2020, you're a nominal beneficiary of this. But maybe you borrowed $500,000 at 7%, in 2024, and you're actually going to be a much bigger beneficiary. So, like, it's a weird provision where we use the value of the home as the delimiting factor, not the amount of interest you're paying.
Is this one of those benefits or changes that has an expiration date on it too?
Not that I'm aware of. This is actually, again, a continuation of 2017 TCJA, and I believe this is actually a permanent, again, insofar as this is a permanent injunction.
All right. What other itemized deductions?
How about the absence of itemized deductions? We carved out essentially all these sort of personalized deductions that used to be out there. So it used to be things like, if you were an employee and you worked for a company as W-2 and you had to drive your car for work, like let's say you're a delivery driver for Domino's, you used to be able to claim mileage, right? And so like Domino's is not paying me to use my car, but I have to use my car for my job all the time. You used to be able to claim that mileage and get that off, but now you don't get that benefit in the same way. Little ticky tack stuff like teachers used to be able to deduct like a couple $100s for class supplies, which is criminal, by the way, because every teacher I know it comes out of pocket for a remarkable amount of stuff in their classroom, which is a shame. But they really just sort of scrapped all of that stuff. For better or worse, this reduces some sort of ticky tack complexity, but unfortunately, I think a lot of that ticky tack complexity probably targets people who are on the lower end of the socioeconomic spectrum. Now, we could then try to make the generous argument here that the increased standard deductions help offset that anyway, but it was there, it was out there. Some people are benefiting from it, and they've just decided to sort of take that away.
If I had to guess, though, I'd say the increased standard deduction is a greater benefit than having these itemized deductions, because I'd assume a lot of these lower income folks it may benefit don't even take advantage of it, and it's almost more hassle than it's worth, and the standard deduction just kind of makes up that difference anyways.
I kind of just want to have my cake and eat it too here, Daniel. Like, if I'd like the increased standard deductions, and I'd like to keep the ticky tax stuff. I don't actually disagree, right? If you said like, do you just want $5,000 more off your taxes, or do you want to be able to like submit receipts to get maybe $5,000 off your taxes? Fine, give me the 5,000. But it is just one of those things where you look at it and go like, okay, yes, there's an offset here, but I'm sort of eye narrowing and frowning at it a little bit, because to some extent I'm like, all right, but like, who's actually the beneficiary or who's harmed by this? We gave a benefit to everyone, and we did a harm to some select audiences. And I look at who those audiences are and kind of go like, okay, like, I don't know that everybody needed a tax benefit, so that teachers also got a tax benefit that offset their loss of a unique benefit that they incur personally. I don't know. This all cuts against my deep libertarian roots that just says everybody should pay 15% and call it a day. But whatever.
All right, so some ticky-tacky itemized deductions there. One that I do think is pretty significant is the salt and pepper deduction. So let's talk about this one.
I don't know that pepper goes into the name, Daniel. I don't recall seeing pepper anywhere in that statute.
I could have sworn I saw it somewhere.
Say, what's the song? Shake it real good. All right, I'm going to stop trying to do hip hop references from the '90s. Why don't you take a swing at this one, Daniel? How do you think the salt deductions have changed?
Okay, so my understanding is that in the past, the state and local tax deduction was capped at $10,000, whether you were single or married filing jointly. From what I understand, that's now been increased to about $40,000. And I also believe that this is something that's going to be increased at 1% annually. What I'm a little tricky about, what's a little tricky for me, I guess, is the income phase outs, which seem like they're pretty significant for those making close to $500,000, I believe.
Yes, I mean, first of all, I know some people listening to this are going to break out their small violins for the $500,000 income earners having to pay potentially more taxes. But essentially, what we did here is we said, all right, if your earnings are greater than 500,000, then we're going to start to take away your deduction accessibility here. So the SALT limits that were passed in the Tax Cuts and Jobs Act back in 2017 essentially capped all the deductions you could get from state income tax, property tax, and so on at $10,000. That was both for single and married folks. The weird kind of hand in hand with that then is that they just said for married filing single, we're just going to cut it in half, 5K, no free lunches here. What they've expanded that to is the 40,000, which I'm going to say that's actually going to help a lot of people here in Colorado. It's really going to help people in states like New York and California, because like we have a California client who loses out on something like $80,000 a year in state income tax deductions. Unfortunately, because of his income level, he's still going to lose out on those deductions because he's going to be past the phase out. But really the key thing here is that this phase out happens from 500,000 to 600,000, and that means that there's a $30,000 deduction on your taxes that's evaporating between 500,000 and $600,000 of income. And so quite problematically then, that means that you actually, from a taxable income standpoint, end up between 500,000 and 600,000, you end up $130,000 worse off than you would if you're going from, let's say, 400,000 to 500,000, where you would just be $100,000 worse off from a tax perspective. And again, small violin. Oh no, you made 500,000 instead of 400,000. Boo hoo. You made $600,000 instead of $500,000. Boo hoo. But it is a tax planning item, because it really says like, hey, from a tax planning standpoint, I kind of want to stop my AGI at 500,000 if I can manage it. Or if I'm going to go above that, if I'm going to end up north of 500,000, I kind of want to blow straight through it. I want to get to 650, 700, 800, something like that. Because living in the middle of that $500,000, you're really taking kind of one step forward, half a step back with your taxes for that $500,000, $600,000 line. The other item here, also just to be aware, if you try to do married filing single, once again, just like it was in the TCJA, they just cut it in half and said, oh, now it's actually 250,000, no loophole for you.
Yeah, this one stuck out to me as one of the, like, as you said earlier, some of these are more just long-term items, keep them in mind, but the tax preparer is going to have to be the one that really has a firm grasp on this. This seems like one of those that immediately stuck out to me as okay. Anybody that has an income married filing jointly of around 500,000 for the next couple of years, the sirens go off in our heads and say, okay, there might be a planning opportunity here, whether to defer some of that income or just blow right through it to kind of save on some of these advantages, if that sounds accurate.
Yeah, and I mean the other thing here that just you have to keep in mind is, like many other things, this one's going to expire in a couple of years, so it's relief, but it's temporary relief. Again, generously helps them with the scoring for tax policy. Ungenerously, I think it just puts a sort of Damocles over tax conversations again at the end of this administration. So we're going to have hopefully some consistent tax treatment for the next 3.5 years, essentially. But then once again, we're going to have to revisit all of this, and assuming Congress does nothing, which I don't think it will do nothing, but assuming Congress does nothing, taxes will suddenly spontaneously get worse again in a couple of years.
And out of curiosity, the 1% annual index, it seems so nominal. I guess what's the point there?
That's one where I don't want to look the gift horse in the mouth because so many tax policies don't index for inflation, which again is always a scoring thing because if it doesn't index for inflation, then the government gets to say it's going to make more money over time because of that. So I want to be really hesitant about looking at it. I think they're trying to be logical in that a lot more tax stuff should just index for inflation, and like tax brackets, index for inflation, various things like that. So I think they're trying to align with that, but they're trying to really limit the amount of inflation for scoring purposes. I think if they didn't need to satisfy scoring purposes, then they probably would have just made it an inflation adjustment, like a pure inflation adjustment instead of just 1%.
All right. That seems like the biggest itemized deduction, at least I was thinking of at first glance. Or are there any others out here that we're leaving on the table?
Not so much. I mean, there's plenty of little things here, and we'll talk a little bit about some negative impacts and itemized deductions. But I think I'm going to save that maybe for, I don't know, topics that don't quite fit safely in another category for later in this conversation.
Great. All right. So I think a natural progression from there is just businesses, right? And we talked about kind of just individual and filing taxes and the brackets and the changes there, as well as the standard deduction. Now, talking about some of the itemized deductions or lack thereof, are there just things that are going to impact business owners?
I mean, really, just two beneficial things. Number one, the pass through entity tax exemption vehicles used in states with high taxes or high state income taxes get to continue, which is nice. Those were sort of on the chopping block in earlier drafts. But for everybody who has no idea what I'm talking about or is unclear about what I'm talking about, essentially, because the SALT limits were so punitive to businesses, every state with income taxes came out with a scheme where essentially they said, listen, if your business, if your S Corp, if your C Corp, pays the state your income taxes, we will count that as a deductible business expense and count it as a payment of personal income taxes. So that's just a clear cut advantage given to business owners under the PTET schemes. It didn't apply to pass through entities as far as like your disregarded entities like an LLC, sole proprietorship or something. But if you had a S Corp or a C Corp, then it allowed you to pay your state taxes through the entity and essentially avoid some of the double taxation issues that the SALT really creates. I think the other thing that stands out is Section 179, which has to do with how much you can expense or deduct in the current year, as opposed to having to do depreciation or amortization schedules for assets and property that you purchase as part of a business. And not only did they, essentially kind of true that up because it was starting some of that stuff was starting to kind of expire or go away, but they also actually raised the limits on it pretty dramatically. So they took the limit from essentially 1 million to 2.5 million on sort of immediate deductions and costs, and they raised the phase out for properties from 2.5 to 4 million, which is kind of nice.
So Section 179, just to clarify a little bit, typically if you take depreciation, you do it over a prolonged period of time, reaping a small tax benefit, kind of divided by the sum of whatever the depreciation amount of time is. You're telling me that instead you can do most of it or all of it in the first year?
I mean, essentially, you can just write it off out of the gate, and you've always been able to do write-offs for like small expenses. I think the limit right now is $2,500. Like if I buy like a Surface Pro and it's $2,000, we can just write it off as an expense immediately. I don't have to put it on the books. But if you bought like a big bulldozer or like a warehouse or something, you'd have to do these really long depreciation schedules where you might spend $150,000 on this bulldozer, but you didn't get to expense the whole bulldozer in the first year. So now there's these increased limits, and it doesn't sound like a big difference. You're like, look, you're going to get the write off at some point anyway. But the value of depreciation schedules, whatnot, from a tax standpoint, is often then that from a policy standpoint, and encourages borrowing. That rather than spending money out of pocket and then having to pay taxes on the money that you don't have in your pocket anymore, you're better off doing a lot of borrowing to make big material purchases or big property asset purchases, because then your payments sort of align with the amortization a little bit better versus being out of pocket for a lot. But again, raising these limits dramatically, and it's like the funny thing here is somebody out there is gonna be like, oh, this is for like big business. Not really. This is a really good item for like a construction company, just like a local contractor builds an office or two every year. That's who's a really good beneficiary for something like this. Even like a business like ours, almost everything we spend money on is below the $2,500 limit. So like it helps us with something like, oh well, we bought, I don't know, like a really nice decoration that cost $3,000. Well, okay, then that helps us a little bit. But otherwise, generally speaking, is really actually kind of targeted at the small mid business more than it is big business or just trying to give handouts to ultra small businesses.
All right, and for this specific one, is there like if I bought something say 40 days ago, can I now use this, or is there like a time limit on when I would have had to buy the equipment or whatever the thing is?
It applies to, and this is really, really political. It applies to all assets purchased after January 20th this year. So, as of the day we got our new president, who is responsible for signing this big, beautiful bill, you get to do this. But if you bought any stuff in a hurry before he became president, you're out of luck. All the old rules apply.
Could just be a coincidence, Dan.
I don't believe in coincidences, particularly when it comes to laws written by politicians.
All right, so you said there's really only two for business owners there. It looks like we covered both of them.
Those are the ones that are really specific for business owners. There's again a lot of like little miscellaneous stuff here that I think we can talk about, where some of it's for the business owners, some of it's for the employees, some of it's sort of hand in hands between them. So yeah, I mean, I think that's it really for the big business items. There's definitely some non-tax stuff out there for business owners in the bill, but not what we're really going to talk about here.
All right. So then everything else probably just falls into a other fun things / miscellaneous kind of area.
Yeah, I mean, more or less, and I don't know about fun, but sure, we'll say they're fun to talk about. Whether it's going to be fun in practice, I'm going to say tip your tax preparer. That's how I feel about some of these items.
It's been fun for us, I'd say. If anybody's watching on YouTube, we have been smiling a decent amount of the podcast here.
And I'll say here, and again, I'm really trying to stay out of the political arena here, other than sort of the jibs and jabs. But like, we live in an absurd timeline where, like, I look at this bill and I'm like, wow, what a bunch of solutions in search of problems. Like, what? Like, it's just a fascinating thing. Where like, all politics is partisan. Every victory is for somebody, is a loss for somebody else. Yada yada. But it is one of those bills where I'm just like looking at like how absurdly specific some of these things are, and it's just making me just roll my eyes and laugh about it, because like I'm not really a beneficiary or a victim of anything in this bill. I don't really care in any material sense, but I do look at this and I'm just like, oh my god, we're just pandering to so many like niche specific interests as we do this.
All right, so what else do we have? Outstanding items or fun, maybe not so fun.
I mean, here's a one that I think anybody listening to this should pay attention to. So here's your focus. Pay attention really closely here. Employers can permanently, so this is one that does not expire, employers can now permanently pay $5,250 toward an employee's student loans and exclude those as income. So why am I saying that anybody should pay attention to this? Like, if you have student loans, if your son or daughter has student loans, if your brother, cousin, friend has student loans, go talk to go talk to your employers about paying the student loans as wages. Saying like, hey, I make $60,000 a year. I'm paying $6,000 a year, 10% of my income towards my student loans. Can you take $5,250 of my annual salary of $60,000 and apply it towards my student loans instead, so I don't have to pay taxes on it, and you don't have to pay taxes on it, like, awesome. That would actually be terrific. I think that's a really good provision that happens to be in this because this benefits employers, this benefits borrowers, and also really gets at something, which is a lot of our college savings mechanisms and things that exist to date, like 529 plans, have been written for the benefit of saving and investing to pay for college. And we've not had a lot of work done around student loan relief for people who had to borrow money to go to college. So that's just one really specific thing where I look at that and I'm like, all right, this is a win for everybody. I have no complaints about that particular provision.
Yeah, that sounds great. So you said $5,250. Is that year over year, index for inflation? Is there a end of this provision?
Index for inflation, and it's permanent, at least insofar as these things are permanent. So, 5250 has been the number for other things like spending money on employee education without having to include it in their income. So now, again, this is a nice one here because, I'll use you and Emily as an example, right? Like part of your career path and professional development path as you at some point going to grad school, Emily at some point currently today going for her bachelor's, and then eventually going to grad school, and we've been allowed to pay 5250 to schools for your education directly, but anything above that would have to be treated as imputed income. And so we say, like, that's the cap, that's what we'll pay for. But in turn, right, your ability to now say, okay, well, I can pay 5250 this year, sorry that you're going to borrow this year, and I can pay 5250 next year, sorry if you have to borrow in the intervening time. But there's a world now where you can have some of your education paid for and then continue to have this education benefit rolling forward and have your employer just start to pay off your student loans accrued above those limits. So it's nice because it's solving on the payment side, solving on the loan side, and again, we're indexing for inflation. So that will make things a lot more easy to pay for, because I think professional development's a valuable benefit for employees, and it's even more valuable to employers to help your employees become that much more skilled and talented. And this is just a great mechanism to help you do that.
Is this one of those where if I only use, say, 3,000, I can roll the extra 2,250 to the next year? Or is it every single year, 5,250, use it or lose it?
It's going to be a use it or lose it cap. So but again, like, that's a scenario where, let's say you need to take out $10,000 this year. So you take out, we spend 5,250 on you right out of the gate. You borrow the 4,000 and change. And then, next year we're maybe not spending money on your education, but you have this 4,000. Well, we can just wipe that out for you. Right. So we can use next year's ability to take that deduction and pay off older debts or older things. So in a way, it allows us to sort of amortize some of these education expenses out over time, where employers and employees can collaborate and coordinate to kind of get the most tax efficient bang for our buck around how this stuff gets paid for.
All right, great. I think that's a pretty neat benefit there. One of the ones that I was hearing about was no tax on overtime, no tax on tips. Is that true? And what's the deal there?
Kind of. So I'm going to describe both of these because they're essentially identical provisions, which is sort of interesting, but it kind of makes it easy. So the only difference is how these are defined. We define overtime as, right, overtime the way that it was defined in the Fair Labor Standards Act of 1938. Okay, so essentially the way anybody's ever thought about overtime in the United States, I work past 40 hours, work more than 12 hours a day, whatever, like that's overtime. That's how we think about overtime. In tips, yes, they've said essentially that they're going to say, like, only qualified tips, and then only in qualified occupations where tips are normal. They're going to publish a list sometime in the next few months specifying. But, like, essentially, if it is a normal part of your work and day and job to get tipped, and, like, that's really how you actually make your money, so think like waiters, bartenders, those sorts of folks, right? They're going to be the target for this. Okay, so with those two qualifications around overtime and who is tipped or gets tips, essentially both categories are going to be allowed to deduct up to $25,000 of tip income, as long as the household income is less than $150,000 for single people or $300,000 for married folks. And then the deduction phases out at 10% of any income above those limits. So you then would have to make another $250,000 to lose the entire exemption as a single person, which, if you're tipped worker, is almost certainly not happening. Maybe in very select occupations, but I'm not going to get into that. And same thing in overtime, where maybe like one of you, works 60, 70 hours a week in like an oil and gas or something. So you work a lot of overtime pay, and the other spouse is like a doctor or a lawyer or something. And so our aggregated income could be as a married couple, higher than $550,000, such that we then lose our, exemption for overtime. But otherwise, $25,000 of tip income or $25,000 of overtime income is a pretty big boon for most of the people who are going to be eligible for tip income or overtime income. So that's sort of the nice thing. The one gotcha in this is if you're married filing single, you are just completely carved out of this. They didn't like cut it in half or play any little tic tac games around like, well, then it'll be a little bit of this. They were just like, nah, if you don't file jointly, you don't get this benefit. So you got to either be single, head of household, or married filing jointly to get a write off on overtime or write off on tips.
Okay. And taxes. So is this state, federal, employment, social, and Medicare? We're all eliminated for this?
Just federal income tax. State by state, now I'm sure we'll see a rash of like state legislation where some states are going to be like, yes, we're going to exempt it too. And other states are going to be like, nah, we're not going to exempt that. That's dumb. So this is, again, sort of a tip your taxpayer sort of thing, which, by the way, they're probably not going to be on the list of occupations. So sorry, taxpayers, you get to pay tax on your tips. But tips your taxpayer, because I think in a state like Colorado, you might get that $25,000 deduction on taxable or tip income, or overtime income, but you're probably still going to be paying your 4.4% on your state income. I think that's probably pretty likely in a lot of states. It's going to be a state by state thing, and you do still have to pay your payroll taxes. So that mandatory withholding for OASDI, Social Security, Medicare, all that stuff is going to still come out. So it's less tax on tips, not no tax on tips, and less tax on overtime, but not no tax on overtime.
Got it. All right. So is this one of those that's going to be around for a while and folks can start to plan on?
Nope. It is a clearly partisan one. It expires at the end of 2028.
So I can use it this year, 26, 27, and 28, so only the 4 years?
I mean, you, Daniel, are overtime exempt, so you cannot use anything.
You in a general sense.
Yeah. I mean, you can take advantage of it this year. You can take advantage of it next year, 2027, 2028, but then past the next presidential election. And here's what's going to happen, right? Both parties are going to have something to say about it. If you elect me, we will keep doing this. If you elect me, we won't do this. If something. But it's going to be a poker chip that gets played with.
How fun.
For better or worse.
All right. Any other miscellaneous items out there you want to talk about?
Yeah. So I touched on this earlier, but historically, right, charitable deductions were only deductible if you itemized. They added in just like, hey, if you take the standard deduction and you're single, you can write off up to $1,000. If you're married filing jointly, you can write up to off $2,000. That's all great and good. There's a catch here. This only applies starting in 2026, not 2025. So, particularly then, as I talk about my next thing in charity here in a moment, there's a scenario where, you might want to delay your charitable giving until next year, depending on your situation, or you may want to front load it into this year.
Okay, and why would you want to do one or the other there?
Terrific question, Daniel. Thanks for asking. Because if you do itemize your taxes, if you're the classic beneficiary of charitable deductions, you can now not write off charitable gifts that are less than 0.5% of your adjusted gross income. So that's an interesting one, because essentially, let's say you make $100,000 a year. That means if you donate up to $500 a year and you happen to itemize, you don't get a deduction. So then in that situation, if you did the standard deduction, you're single, right? You get a $500 deduction. But if you itemize, you don't get a deduction. In turn, this means it scales, right? So if you're making $200,000, $300,000, $400,000 a year, your first couple $1,000 of donations are just out of the goodness of your heart. But on the other side of that, you can still get charitable deductions. It just really kind of carves up a little bit of this barbell of like, people who are standard deduction people should only donate so much. People who are itemized deduction kind of need to donate more for it to make any sense.
That's interesting. So not a cake and eat it too scenario here.
Not a cake and eat it too scenario, but I will say there is cake. Again, back to the single married filing jointly standard deduction folks. You now actually get some benefits for your charitable deductions. Yay. like that is a win. But we're definitely not getting to eat the cake too. The AGI thing is sort of annoying for the itemized filers.
All right, fine. What else do you have for me?
Car interest loan deductions. So you can deduct up to $10,000 on car loans, just the interest, not the principal. Which I guess helps with purchasing cars. This one's pretty targeted. It's not even so much political as it is like just sort of like an America First sort of thing. Specifically, your income can't be greater than 200,000 if you're married filing jointly, not more than 100,000 if you're a single head of household, and then the deduction phases out essentially 20% at a time. But essentially, for any loans issued between January 20th of 2025 to 2028 for a car that is new, not leased, and not used, right? So a new car, and specifically a car that is manufactured in the United States, at least that final assembly is completed in the United States. So you can't like buy a foreign car and ship it over and get this. But if you take out a car loan and you're making less than 100 grand single or making less than 200 grand married, right, then you might be able to deduct all of or some of the interest on a vehicle you purchase as long as it's purchased brand new between 2025 and 2028 and it was built here in the US.
All right, yeah, makes sense. Seems pretty straightforward.
Well, it seems pretty straightforward. I'll say this helps somewhat with the calculus when clients come to us and say, should I pay cash or should I borrow? This does help a little bit with the should I borrow calculus. It's not perfect, right? We're talking about a deduction, not a tax credit. So you're only going to save, 20, 30 cents on the dollar, but it is a savings. It is material. It also, the phase out's pretty aggressive, so it's not quite a cliff, but it does really kind of put a bright line at 100,000 or 200,000 of income about whether it does or doesn't make sense because it gets more complicated and gets less beneficial if your income is north of those figures.
Got it. All right. I think there's some stuff about the child tax credit increases too in there. Yeah.
Yep, goes up by 10%, and will also now inflation adjust going forward, which love that because it's always been this weird, very specific, flat $2,000 during COVID. We had $4,000, but it's always just been like this very de minimis thing where it's like children cost a lot of money. I don't know that $2,000 defrays the cost of my child. So it's nice that that bumped up at least a little bit. It is effective this year, so anybody who has kids, you're going to get an extra $200 a kid this year. Congratulations.
Sweet. All right. Keep going. Let's do it.
Another one, and this is sort of an interesting one. So you've been able historically to get a tax credit or of up to essentially $16,000 in change for adopting a child, which is terrific because adoption is very expensive. So essentially, you could spend money on adopting a child instead of paying taxes. But the big gotcha has always been that it was not a refundable tax credit, meaning that if you had already paid all your taxes, you actually didn't get any benefits for it. Boo. They've now made up to $5,000 of that tax deduction actually refundable. So if you actually paid all of that, all your taxes for the year and you didn't owe anything, you could at least get up to $5,000 back. They might still spend 10, 15, 20, $30,000 to adopt a child, but at least it is helpful and that helps defray that a little bit. I really wish there was something in this for parents just having children. Like I wish there was a maternity tax credit, a paternity tax credit, but it is what it is. There's now some refundable tax credits if you're adopting children.
Great. I think one that I just realized we haven't touched upon yet is estate and gift tax exemptions. I believe those figures that are already pretty large have been increased a little bit more too, right?
Yeah, the rich get richer. We went from $13.99 million per person to $15 million effective next year. So if you're thinking about dying this year, hold off until next year if you want your estate to be that much more protected. But yeah, the estate tax exemptions just keep getting bigger. I'm sure this is not the last we'll hear about it either. But on a going forward basis, one of the big cliff questions we had for tax planning since 2017 was, are the exemptions going to go away? Because if they did not continue past 2025, there was then sort of the opposite of like, hey, if you're thinking about dying sometime in December or January, it should be nice if you died in December. Strangely, now we're going the other direction where the change in tax policy now makes it better to live longer, which is not a bad thing. But that was a strange sort of adverse incentive that was in the tax code for a while there.
And I think an important point to add there too is that's 15 million per person, right? So if I'm married, we each get 15 million for a sum of 30.
Yeah, and I'll be honest, like they're indexing it for inflation. It's going to go up, yada yada. I'll be honest, as a financial planner, I would love it if they stopped indexing it for inflation because it's so ticky tacked. Like, well, the exemption this year is 13.99 million and change, and it'll go up by 2.4% next year. So, like 15 million is a great number. 30 million for a married couple, great number. But no, they're still going to inflate them because we can't possibly not inflate the thing that lets people who are ultra wealthy pass ultra wealthy wealth to their families over time.
All right, that kind of covers most of what I had in mind here. What else am I missing?
The most blatant political pandering in the entire bill.
And what would that be?
We are now going to have Trump accounts, or about a year from now, we're going to have Trump accounts in the same way that we have like IRAs, Roth IRAs, 401ks, etc. And Trump accounts, or I might just call them TRUMPs just to be annoying about it. But TRUMPs are essentially special IRAs to save for children, essentially. But they're sort of like a weird hybrid. So essentially, these accounts will spring into exist a year from now, or these will be available a year from now. You will be allowed to contribute to them for any child under the age of 18. So for a minor, right? And if a year from now you're going to be over the age of 18, sorry, no Trump account for you. You can only put $5,000 in a year. That does not appear to be indexed for inflation, but maybe it will be. That's sort of a TBD. You cannot distribute money from it until you're 18. I'm assuming the bill is not very clear about this, but I'm assuming there will probably be a 10% early distribution penalty sort of setup here. And then these are tax advantaged, not tax free. So these are going to be like your 529 or like your IRA, where you put money in, you don't necessarily get a deduction for it, but then it'll grow tax deferred. And then when you take it out after the age of 18, at a time, then it'll be subject to ordinary income tax, not capital gains tax or anything like that. Um, all of this sort of just makes these like weird alternatives, like a 529, maybe a slightly enhanced version of a UTMA, but then we get into kind of a conversation about ordinary tax rates versus capital gains rates. So it's just sort of an alternative. I think the most interesting thing about this is really just sort of kind of some of the terms and conditions about contribution and what it can be invested in. So you can, as an employer, back to sort of a similar thing to the education student loan reimbursement stuff, employers can fund up to $2,500 into these and not count it as income. So again, sort of a negotiation thing where if you are an employee of a company and you would like to use one of these accounts to save for your kids, you should talk to your employer and say, hey, I'd like to take $2,500 or some amount of my salary below $2,500 and put it in this Trump account instead. And then you save on taxes and I'll save on taxes. So it's something interesting to potentially do. The government's going to do a weird pilot program where any child born between 2025 and 2028, as long as you open a Trump account for them between 2025 and 2028, they're just going to throw $1,000 into it for you. So some free money in there for anybody who has newborns. And then I think this is actually the most interesting thing. It's the only account I've ever seen that is ultra restrictive around what you can invest in. And almost in a really good way. Like I hate to say that, but like it's sort of fascinating because I don't usually like restrictions that much. But it has to be invested in mutual funds or exchange traded funds. You can't buy stocks, you can't buy crypto, you can't buy any of this other stuff. And it has to track. If the statute says explicitly the Standard and Poor's 500 index, the S&P 500, or any other equity index that's primarily investing in U.S. equities. So like things like the Dow Jones, the NASDAQ, something like that. It cannot use any leverage, so no leveraged 3x funds or anything like that. And it cannot cost more than 10 basis points a year in product cost. So the funds you invest in have got to be essentially low cost index funds investing in U.S. equities. That is a absolute requirement in the statute. And then they have sort of this catch-all of like, and then any other criteria the secretary wants to throw on this in the future, which who knows how it will go. But I think that's probably one of the most fascinating things because there's very few accounts that have really strong restrictions on what you are and aren't allowed to invest in. Usually the restrictions are things like, hey, if this is supposed to be an ultra conservative like fund for an endowment for like a children's school or something, you can only invest in like U.S. treasuries or municipal bonds. This is the only account I've ever seen that says like you've got to just go all in on America. So again, very blatantly partisan, very obviously pandering, TRUMP accounts, Trump accounts, but it is interesting, if only for the fact that it is unique.
Yeah, so it kind of seems like a mix between At present, we have 529 plans and UTMA accounts. Kind of seems like a medium between the two, kind of that you can use for some of these longer term goals for some of your children. That being said, can you still just use a brokerage? You might not get the same tax benefits, but that still might be a realistic option for a lot of folks here.
Yeah, I mean, here's sort of the strange thing. Other than I think really specifically the employer's ability to contribute to it tax free, which like that's if there's a single case to invest in these accounts, like that's the case I'm looking at. But otherwise, I think just in a general sense, for somebody who's like, well, I don't want to save for college, but I do want to save for my kids, I'd still probably default to a brokerage account because not only are you going to get long term capital gains treatment if you manage the account correctly, but also then you essentially have no better or worse of sort of control flexibility. And again, you're going to get preferable tax treatment coming out of it. So, funding wise, there's some advantages here. Technically, they're going to be less complicated from a tax standpoint as far as accumulation goes because we won't have to pay taxes on capital gains from reinvestment or dividends or interest or something like that. But then long-term capital gains is way preferable to ordinary income tax rates in most cases. So that's a situation where like funding, I see some advantages. Distributing, I don't see a lot to love there.
And at the end of the day, too, if we were recommending, we'd probably be putting it in something similar to the restrictions that are placed on the Trump accounts, anyways.
I mean, probably as far as like how we invest and whatnot. Yeah, I mean, our most expensive portfolio we invest in is 0.06%. The most expensive fund we invest in is literally 10 basis points. So any portfolio we manage is not going to have a problem with any of this. There's actually a question here, which I don't know the statute directly points at, which is, like we charge management fees to clients through their calculation, and I don't think that product limitation applies to advisory fees, but I think that's going to be an interpretive item that might be a little bit weird over the next year about whether paying somebody to manage that account is permitted or not. Yeah, and to some extent, right? If you're just going to shove $5,000 in a year into an S&P 500 index, fair enough. But I think that's sort of an interesting mix.
Great. So, is that it? Are we done here?
Almost. I think there's three other things that are important because there's some deadlines here. Electric vehicle tax credits, at least at the federal level, go away as of September 30th of this year. So if you're going to buy an electric car now, buy it now. Energy efficient home credits go away at the end of this year, and residential clean energy credits go away at the end of this year. So same thing around like if you wanted to get solar on your house, if you wanted to do some insulation or some stuff to improve the energy efficiency of your home, get it done before the end of the year because those credits are going away.
Sweet. So I'd say to wrap it up, at the end of the day, for those that don't want to listen to the whole thing and skip to the end, who wins here? Who makes out, and like who kind of doesn't really get that impacted, and maybe who loses?
The real winners are the people who listen to the whole podcast, and the losers are the people who skip to the end. Now, I think really, if you were winning from how the Tax Cuts and Jobs Act structured things back in 2017, you're just doing more winning in that sense. And if you were disadvantaged by the Tax Cuts and Jobs Act back in 2017, I don't know that you're any worse off because there's just a lot of tax cuts and increases to deductions and little loopholes and things you can do. So I don't know that anybody loses per se, but like if you are, let's say, a financial planner or a lawyer or a doctor, where things like the qualified business income deduction, were explicitly disfavorable to you as a specified service or trade, you are still a disfavored category here, and it's just a womp womp sort of scenario. But if you're a construction worker, if you're a business owner who owns, let's say, a small tech startup or something like that, there's just as much to love in this bill as there was in 2017 because it didn't really take anything from you and it kept all the things that you were enjoying intact or improved them.
All right. Well, I'm glad we talked about it.
Yeah. And I don't know, Daniel, did you learn anything this week other than how much crap you can shove into one big, beautiful bill?
Well, I mean, even just going off of that, right? Like, it is big, right? And there's a lot of folks out there that hear things in the media and, maybe they hear headlines and don't know what's actually in the bill, what's just garbage, right? And a lot of people pay us not just to help them grow wealth, but for approval and peace of mind and to save time. All of which us reading this bill and parsing out the good and the bad for them is really important. And I think it's a great example of just what we do for clients and the expectations that they give on us. And I think we're grateful that we have them and are able to parse this knowledge out for them as opposed to having them figure it out for themselves.
Yeah, I mean, don't get me wrong. This stuff is not getting any easier or any simpler. And I know I made the joke a couple times, but like it's just another solid case of like tip your tax preparer. There's more and more and more government, social, and fiscal policy being passed through tax returns than there ever was a decade or more ago. And it's something where, I think the barbell of professional services is really starting to kick in. You're either going to have to start doing stuff yourselves, or you're going to have to pay a premium for people who really get this stuff. And again, we don't prepare taxes. I'm not trying to sell you on anything. What I'm saying here is, this stuff is not getting easier. It is becoming more important to either keep your situation as simple as you possibly can so that it's feasible to do it yourself, or you are going to find yourself paying thousands of dollars for highly qualified tax prep because God forbid you mess it up. It's not getting any easier.
No doubt. I'd say the last recommendation I have here is if there's anybody out there, though, that does have trouble sleeping, reading the bill is an effective remedy to kind of, fall asleep. So
it's a huge sleep aid. The Science of Wealth is produced by My Wealth Planners, a registered investment advisor in Colorado. The theme song is This Is Your Time by Dan Phillips. The podcast is intended for educational purposes only and is not investment advice or any other form of advice. Not all material discussed on the podcast is appropriate for every individual in every circumstance, so you should consult with a certified financial planner, tax professional, or legal professional as appropriate before attempting to apply any of the subjects, strategies, or tactics discussed on the podcast.